Okay guys, good morning and welcome to this lecture. I'll be teaching you a very interesting model which is called the Nest bar model, and I'll also be teaching you a very simple strategy which is quite mechanical, which you can use to you know you can use to pretty much build a career around, right? And change your story. Okay, one of the reasons why I'm sharing this model is because I've decided to, help the community and impact on the lives of people. Okay, and I've chosen to do it on the 28th of May because it's a special day for me. It was the same day I lost my dad, and I thought that I could use this day to help. Okay, going forward. All right, we say prayer for him. Eternal rest grant unto him, O Lord, and let perpetual light shine upon him. May the souls of the faithful departed, through the mercy of God, rest in peace. Amen. May their souls rest in peace. Amen. Okay guys, so welcome to this one. We're going to run through this as quickly as possible because I really do not want the videos to be very long. Okay, but trust me, if the videos if the videos turn out to be quite long, I want to tell you to take every part of it. Don't skip any part of it because they will all be equally important. All right, so these are the things we're going to be going through. I'll talk about the cycle of emotion. This is where the concept is coming from, right? Everything, if I give you a chart of a weekly chart or a daily chart or a 1 hour chart without labeling the chart, you find out that everything is the same. Everything is pretty much the same. You cannot differentiate which one is weekly, which one is daily. Why? Because what you see on the chart from 1930 down till today is an interpretation of human emotion, and I'm going to show you that roller coaster which drives the market. I'm going to show it to you here, and then we will see how what part of it we can capitalize on, even though you may not be able to 100% predict that this is the phase we are in, but you should be able to say, okay, yeah, I think the market is capitulating, or I think people are optimistic about this market and now it's about to reverse. Okay, so we're going to look at bar anatomy. We're going to look at the different types of bar. Okay, we look at different types of bar anatomy. We look at the functions of the bar, and the functions of the bar is going to help us to generate a model to help us know what the next day is going to be. We are going to also look at the key concepts of the strategy. What are some of the ideas that we are going to be working with for this strategy? And then we describe twist of fate. We look at a couple of entry models, and then we draw out a mechanical trading plan, and then we look at a few trade samples, and then we jump into an exercise. Okay, so if you're ready, let's do it. Okay, so here is the cycle of emotion. Now what I want you to observe is that this is so this is the price, this is the time, right? So if you're taking a look at this already, you can start to see very quickly what is happening, right? If the market starts, it runs off, there's a bear trap, right? There's the people who think that is going to continue selling here it traps them. They think that there's a resumption to sell. It traps them, it pushes up. Now at this point the moving averages are turning. The news, everybody's now posting about it. Bitcoin is going to rise and whatever, and then enthusiasm sets in. The greed sets in, and then everybody starts to buy, and before you know it, it drops. And then there is another bull trap. There's another trap here. Trap is a failure swing. All right, so there's a push up as if we're going to continue. Oh, the market gets to what, 67,000, and then it pushes back to what, 65,000, and then it starts to rise again. Now people are thinking, oh, it's going to now go to 100k, and then that's a bull trap. Everybody who is buying here is going to get trapped. And then what happens? It pushes below 65k, goes down 62, 63. It's going down. And I'm not saying that that's where Bitcoin is right now, but we could be seeing capitulation that takes us back to the mean, right? Back to the mean price. What I'm trying to say is, you can see that this is what happens in the market. It's a continuous cycle, and that's why you see that the market is always almost the same on any chart, any time frame, regardless of the asset, regardless of what you're trading. You're going to see a distribution of fear. We're going from one stage to another. All right, you can see this is what the emotions look like, right? The emotions go from when the market starts to rise, and then it goes gradually, goes up, it gets to the euphoric stage, comes down, fear. And all of this can be represented even on any chart, 5 minutes, 1 hour, 10 1 day, 1 week, right? You see the market rises, the market goes, peaks, climaxes, and then it drops. If you're still holding, sometimes you're in an uptrend, you're not taking profit, and the market starts to go down, and then you start to feel anxiety. The market goes down some more, and then you that's the point where you stay in denial. You say, oh, no, I think it's just a pullback or whatever. It's going to still go up, and then maybe it goes up a little bit. That's the bull trap, right? And then it falls drastically, and then you become afraid, right? You become afraid, and then it goes below your entry. You start to see some red, and then you start to panic. All right, you start to panic. Then if it goes a little lower, you say, no, I'm not staying inside this thing anymore. I'm done. I'm getting out. That is capitulation. That is the point where you say, I'm done. I'm not trading this anymore. I'm not doing this anymore. And then you leave. So why am I showing you this? I'm showing you this because we can capitalize on people's fear, right? We can capitalize on, we can see in the chart when the market capitulates. We know that if the market capitulates, okay, so if the market capitulates, we're seeing people who are saying, oh, the market is down, is going down, I'm tired, I'm done, right? I'm done, right? And then at the same time, we're seeing people who are who are trapped, right? They've been holding, or they are lured in to sell, and then they get trapped. Okay, some of them will liquidate, some of them will get a margin call, but that's the best chance for us to that's the best opportunity for us to buy. All right, so this is just a further representation of the emotion. You can see how the market moves. All right, and yeah, So this is showing you more details on a price chart, right? This is more details. We're going from hope to disbelief to optimism, to belief. This is a point of acceptance where they say yes, it's going. I know it's going. The next bar is going to be bullish, right? But be careful because it may not continue forever. Okay. Until we see a refusal. Okay, so I'm not going to go over all of this so that we don't take all the time here, but you can take a look at this and go over it, try to read it and understand. What does a candle, a bar is a candle, right? What does a candle look like? A candle looks like this, right? Candle looks like this. We have the open, we have the high, we have the open, we have the high, we have the close, and we have the low. Now I'm going to tell you a very brief story about how this was discovered. It was from a Japanese rice seller, and what he used to do is he would take note of the price. What was the price of rice in the morning? Let's say that the rice starts off at 20k per bag in the morning, and then somehow it went to that morning. It went to, let's say, 22k. Didn't stay there. Dropped all the way down to, let's say, 18k. All right, and then it came before the end of the day. It came back up a little bit and closed at, let's say, this would not be 18k. Let's call this 16k so that we can say it closed at let's say it closed at 17k. Okay, so this is exactly what's happening. So he's seeing that, okay, there are four details here. What is happening is the price did not stay at 20k from the opening, from the open to the close, right? From the moment we all came out to sell, to transact, the price did not stay at 20k. It was changing. Some traders will sell 18. Sometimes it will drop. Sometimes it will increase, depending on several things. What are the number of people? Did somebody come to the market that day to say, oh, I want to take 20 trailers, 20 trucks of rice, right? Was there higher demand? Was there lesser demand? All these things affected the price throughout the day, and he interpreted it with this information. Okay, so this is how it was represented by hand, and then he used it to make his chart, and then he also used it to trade rice. Okay, so that's how we got the Japanese candlesticks. All right, that's how we got the Japanese candlesticks. Okay, so this is what it looks like. I am not going to be dwelling on these things because like I said, I don't want the videos to end up being too long. All right, so what does that mean? It means that if you look at every candle, you have four information: how high it went, how low it went, where it opened, and where it closed. All right, if we have a bearish bar, you have how high it went, how low it went, where it opened, where it closed. Now there are two types of bar. Every candle, every bar on your chart must either be a range bar or a trend bar. All right, there are no in-betweens. It's either the candle is a range bar or a trend bar. Now, if we have this is a trend bar. Okay, this is a full-fledged bar. Now, Why do we say this is a range bar and this is a trend bar? It's very simple. If you look at this bar, if this is a daily, and we want to represent these two candles in let's say 5 minutes, right? We want to represent them in 5 minutes. What are you going to see for this one? For this one, what you see is that, so it's going to start somewhere here. It will range, go up, it comes down, it goes down, it comes back up, right? This is the first one. What is this? This is showing you that the market went like this, came back, closed like this, went this low. This is a range. How do you know what a range is? How you know what a range is that there are some level of rejection on either one side or on both sides. So even if I have something like this, if I have something like this, right? This is a range bar. Why? Because the market opened, market went like this, came back like this, right? So you can see this is not a clear trend. It's a range, right? A trend is a trend. A trend bar, this is a trend bar. You can see the market, the definition here is that the open is the open price and the high price. The open or the close is very close to the high or low, right? The open and the close. The open, this is the open, or let's say this is a bearish. So this is the open, this is the high. They are very close. This is the open, this is the high. They are very close. Sometimes we call this a marubuzu. All right. Take note of what I'm saying now. Now you can see here, this is the open, this is the high. You can see that they are not close to each other. All right, they're not close to each other. You can say, oh, it's only on one side. Yes, it is only on one side, but they are not close to each other. We want them to be close to each other on both sides. That is a trend bar. And you don't need anybody to tell you what this bar is going to look like. It is going to simply just go down. That is a full trend. This is a bear trend. If it's bullish, you're going to see it going up, 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 throughout. It's going up throughout. Okay, so these are the two types of candles there can be, right? There is no in between. These are all, you can call it any name, hammer, whatever, anything you want, but these are the only two bars that anybody can have on their chart. Okay, so that being said, let's see how can we utilize these bars in terms of the function. Now we have a range bar, and we have a trend bar. These are the two types of bar. Every other bar is formed from this. Now what do range bars do? Range bars have two functions. They describe a trading range. They describe what? A trading range. They describe a trading range. They show you that there is a range there, and they show indecision. They show you that we're not sure if we're going up or down. There's a fight, there's a struggle. The bulls were coming, they stopped coming. Bulls were going, they stopped going. That is what it is. All right. Now, what about the trend bar? The trend bar shows the function varies, right? It shows you that there is a trend. Number one, it shows you that there's a trend. It shows you that there is something referred to as acceptance. We are bullish, right? We are bullish. We are accepting higher prices. We want to go higher. That is what this one clearly says. It says we want to go higher. We are happy to go higher. It shows exhaustion. It shows exhaustion. I'm going to talk about this further so that you can see. And then it shows, lastly, it can be used to describe what we call a climax. A climax is, you can see a big bullish bar, but the market is capitulating. The market is bottoming. It's called a climax. That is the last big bar, the last big bullish bar at the end of an uptrend, or the last big bearish bar. You just see the market has been going on and on and on, and all of a sudden it starts to rise really fast, and then there's no follow through. Okay, so you're going up like this. You're going up, and then you get to this point. You can still see a big bullish candle, right? But then there's the next bar. The next bar is not bullish, right? It stops being bullish. It's maybe an indecision bar. You know for sure that this trend bar here is functioning as a climax. Okay, it's functioning as a climax. All right, so I hope that makes sense. Now, all these things are framing the idea that I'm going to show to you very soon, because you're going to need it to be able to describe to know what the next bar is going to be. All right, so there are if we have a trend bar, think about it. If we know that today the market is going to be bullish, all right, if we know that the market is going to be bullish, okay, if we know that the market is going to be bullish, right, market is going to rise. If we know that the market is going to rise, if this is a daily, how do you think the hourly candles will be? Think about it. If this is a daily, how do you think the hourly candles will be? Do you think that we are going to have two consecutive bullish hours? Right? Do you think we're going to have two consecutive bullish hours? If today is going to be green, a green bar, do you think that at any point we're going to see two H4 candles that are bullish? Do you think that is possible? That is possible with over a 95% certainty. And mind you guys, we're not looking for certainty. We're just looking for good win rate, high probability. Right? That's what we're looking for, high probability. Okay? So do you think it's possible? Yes, it is possible. If the weekly, if we know that next week is going to be bullish, do you think that we're going to see two H4 candles that are bullish consecutively? Two consecutive H4 candles along the way that are bullish? Yes, it's possible. It is very possible. Can we trade off of this two candles? Yes. So how do we know what the next bar will be? The market every candle has an interpretation, right? Every candle has an interpretation. There are parts of a candle. This is the week. This is the body. Now, the week shows refusal. I need you to understand this. The week shows refusal. The body shows acceptance. You must understand this. The week shows refusal. The body shows acceptance. The week shows refusal. The body shows acceptance. This is very, very important. If the week and the body covers a preceding candle, it shows exhaustion. It shows exhaustion. What do I mean? There are two scenarios. It mustn't, in one scenario, it may not cover, but the best scenarios are the ones where it covers. If we have a small indecision bar and the next bar goes like this, covers up the low, and the high covers up the entire, if we cover up this bar such that every part of this bar is embedded inside the next bar, this is an exhaustion. It's also referred to as an engulfing, but I'm going to teach you why we call it an exhaustion, right? It's an exhaustion. And think about it. If this candle is bearish, it is going to be the same as this. Am I right? These two candles is what an exhaustion candle looks like. These two candles is what an exhaustion candle looks like. So can we have an exhaustion in the middle of consecutive bullish bars? Yes, we can. What does it tell us? The next bar will be bullish. So if I see this guy, where can you find this guy? In the middle of an uptrend. The market has been going up. At one point, the market looked like it was going to sell. It was going to reverse, but it ended up closing like this. This is an exhaustion, guys. This is an exhaustion. What does it tell you? Sellers have been exhausted. They tried to sell. They could not sell. The market finished up. The next bar is bullish. The next bar is definitely bullish. That is typical example of an exhaustion. I'm going to show you inside the chart in a moment. What if we are going down? We are selling, right? And then we get to a point where the market takes up this bar. What does it tell you? It tells you that the next bar is what? Bullish. Even if the next bar is not exactly bullish, we have maybe an inside bar here. We are expecting higher prices. This is what I'm going to teach you now, guys. We are expecting higher prices. Very important for you to know this. Higher prices is imminent. Take note of this, guys. If we have a bearish exhaustion candle, lower prices are imminent. Now, if the next bar's week is, if the interaction between bar A and bar B is a week, we're already going into the next bar, right? Now, if we have an interaction with this bar, so you have this bar, you have this is the low of this bar, this is the high of this bar. All right, now if the next candle that prints goes like this, comes down and ends up being bullish like this, let's say this one was bearish, and then you have this, what you have here is is what we call a refusal. It's a refusal. It shows that price traded at this level at some point. Remember the right seller, the market got to this area, but they didn't like the price, so they came back up, right? They came back up. So This is a refusal. What does it tell you? They are not happy to trade lower. So how do you know that next week or tomorrow is going to be bullish? If we see something like this, we know that the next day is going to be bullish. This is the next day model, right? What about what I just showed you, with the exhaustion? If you see something like this, and then we're here, you engulf this guy completely in an uptrend, guys, in an uptrend. The ultimate trend is up. What does it tell you? It tells you that there's a likelihood that we can look for a trade under this area to go up with the next bar. Okay. Now, in the same light, as we have refusal, we have acceptance. Okay, we have acceptance. Acceptance is if the body interacts with the bar. If we have this, and then the next bar goes here, comes down a little bit, goes up, closes like this. What do you have here? This is the high of the bar, and then you have it, it's interacting with the body. What do we have here? We have acceptance. What does it mean? It means that higher prices are likely to occur. Higher prices. Now, if we know that higher prices is likely to occur and the market opens here and starts to trade lower, because these bars have interacted in such a way that we can predict that higher prices are likely to occur, we can look for a trade within this bar to take us higher on the next day. That is why I asked you a question. I said, if we know that tomorrow is bullish, is it possible for us to see two H1 candles that are bullish? Is it possible for us to see two H1 candles that are bullish? Yes. And can we trade on the first H1 candle? Can we go in on the first 1 hour candle so that the next 1 hour candle will take us there? Is it possible for us to go in on the first H1, which has shown either acceptance or refusal, to tell us that yes, today is bullish? We are now expecting the next H1 candle to be bullish. Can we trade this and make money? Yes, guys, we can. All right. And this is how I look for it. And I know that there are several ways that people will look for it, but I prefer to simply look at the interaction of the candles. The candles will reveal everything to you. The secret has been there. The wicks have been there all along. The body clothes have been there all along, but you did not pay attention to it. I'm going to show you in the chart in a moment, right? You did not pay any attention to it. Let's just look at any random chart so that we can see how this interacts. You can see, if I don't tell you what time frame it is, you have no clue. Okay, but this is Euro USD weekly time frame, right? We can use any time frame at all. Now I just want you to see how this works. Okay, so do you see an exhaustion bar? This is an exhaustion bar, right? Wicks go here, refuse to close, they refuse lower prices, higher prices are imminent on the next week, right? Same thing again. What do you see here? This is the low. How does it interact with the previous week? It interacts how? Refusal. It means that this week is going to be bullish. What do? Wait. Below this area, I'm going to look for two H4 candles that will repeat this same thing I'm showing you here. Once I see this on the H4 candle, one candle refusing to go lower, I know that a lot of people have been trapped. Trap is edge, guys. Trap is edge. It's emotion. It's edge. Right? What is happening here? Acceptance. Look at the high of this candle. It's being accepted. What's happening next? Higher prices are imminent. What's happening here? Refusal. Why are we not going to take the refusal? Because it is against the trend. We only want to take in the direction of the trend. How do you know the trend if you're a complete novice? Use the 20 and the 50 moving EMA. 20, 50 EMA, that's all you need. 20, 50 EMA. Only look at the interaction in that direction, guys. You will be able to tell what the next day model will be. We have either a strong refusal or a weak refusal. This here is an example of this one, which is bullish, is an example of a strong refusal because it is bullish. Market traded lower. It was blue, it was red at some point, ended up being green at the end of the week, meaning they refused lower prices and accepted higher prices. Right now, if you like, you wait for acceptance after a refusal to trade the next bar. But if you see a weak refusal, this is the low of the previous week, there's been a refusal. I'm not saying any other thing. I'm not saying external liquidity or internal liquidity or fair value gap or anything. I'm not saying any of those things. I'm simply just showing you bar by bar analysis, guys. Bar by bar analysis. If you have this refusal and an acceptance, we are going to have a white week. Higher prices are imminent. All we want to do is look for the twist of fate within the week that will take us higher. That's what we want to do. What is this? This is an exhaustion bar. Look at this bar. Look at the high. Look at the low. The week has taken it out, and then it has come to this low. What is happening here? This is an exhaustion. Lower prices are imminent, but we only prefer to take this in line with the trend because yes, it's really powerful. It will show, it will move, but sometimes you don't get enough surge for you to be able to make enough money from that. Okay, so all I'm showing you here is the interaction. Now this is another example. What are you seeing here? Market goes down. This is a range. This is a range bar. This one right here, range bar. This is range bar. Market sweeps the low. Why is this good? This is good because everybody who thinks that the market is going to, they're optimistic. They think the market is going to keep rising. What does it do? It stops. Now they're scared. They're trapped. People are trapped. What is happening here? People are trapped. What's happening here? A lot of people are trapped. A lot of people are trapped. What do you think is happening here? If you put a week here, if you put a line here, what do you think is happening there? People are trapped. Look at it, guys. People are trapped here. People are trapped. People are trapped. They're trapped. What is going to happen? Higher prices imminent. Look here. What happened here? People are trapped. Lower prices imminent. It is against the trend. So we wait for the ones in line with the trend. But you can see the lower price is imminent. It happens every time. If you have acceptance, higher price is imminent. Higher price is imminent. Acceptance. This is acceptance. Lower price is imminent. What is this? Refusal. It went low, it refused. This is a weak refusal. I'm going to wait for an acceptance. Acceptance is body close. At what point the body close? Body close here. What is happening? After body close, higher price is imminent. Higher price is imminent. We know that once these people are all trapped and the market has accepted that, yes, I'm going to be bullish, I'm going to rise, what do you get? Higher prices. Buy below the open for an asymmetric risk to reward. You want to make sure that your risk to reward is reasonable. So you don't buy up here. You wait to buy somewhere below. That is all we're teaching, guys. What is this? This is an example of a climax. You see a strong bullish bar, no acceptance, no follow through, no continuation. All you see is refusal. After such an interesting bar, you become pessimistic. Refusal here, acceptance here, pessimism. Of course, there's going to be, so we're going to see what we're going to do, guys. We're going to stay together in a group, and then we're going to practice this together going forward so that you can see how it works. Okay, so that you can see how it works. Sometimes I always prefer that you use the moving average, okay, because the moving average, once it turns, it tells you, okay, it's time for you to start to sell, right? Rejection, sell, right? Acceptance, sell, acceptance, sell, sell, acceptance, sell, sell, until you have something like this. After this point, what do? This is what? Strong refusal. Strong refusal, we buy below the open. This week, we're closing bearish, but we know that higher prices are imminent. Higher prices are imminent. Okay, and then I need to tell you this. Nothing is 100%. We're not looking for certainty. We're only looking for something that allows us to win more times than we lose. We want to win more times than we lose. Okay, I can go on and on, but going to extend the length of the video, but I hope you understand what the concept is about. Now, how can you trade this? How can you trade this? Okay, so this is the backbone of the concept, right? This is everything that you're going to see within the twist of fate. Okay, we're buying into strength, we're selling into weakness. All right, well the trend is your friend. This is the greatest quote by my favorite legend, Jesse Livermore, right? The trend is your friend. Whatever you do, if you're in line with the trend, you are better off than anyone who is not in line with the trend. Okay, so you have you have a bullish market, you only look to buy. If you know that next week is going to be bullish, you only look for buys. If you're not sure, use a moving average. A moving average will tell you we are bullish. Okay, and then, is the market condition favorable? Are you going to start looking for trades when the market is all choppy like this? No, you may not make any money, right? So you must have a filtering system to tell you when the market is bullish. Which pairs will you be looking out for? And when you go to the big banks, they always have all this nice technology that helps them to filter out their A+ setups. This is very important. I look at the entire chart like this, right? You can see I have the moving averages. I have 20, I have 50. This is 20, 50, 20, 50, and 200. Okay, so this is because I cannot expand the chart. I use the moving averages to see the parts that I cannot see, and to tell me what the trend is. If this is a daily, if you look at Euro JPY, you can see that there are times when there's been a trap. After the trap, the next bar is bullish. After the trap, the next bar is bullish. It's easy. After acceptance, the next bar is bullish. It's easy. It's easy, guys. It's easy. Just trade in line with the trend. In line with the trend, that's all. Look at this. This is 20 and 50. This is called open window. That's what I call those two moving averages. Open window. As long as the window is open, keep on going bullish. Wait for it. Refusal or acceptance. That's all you need. Refusal or acceptance? Keep going. Refusal or acceptance? Is it refusing? Yes, it's refusing. Next bar bearish. I hope it makes sense, guys. So let's so this is how I filter out where I'm interested in trading. I have daily, I have it prepared like this for daily, for weekly, for monthly. I do not have quarterly. I have the monthly, weekly, daily, H4 and H1. I want to see each bars, you know, on the chart like this, and which ones are likely. All I'm looking to do once I know that there's been a refusal or an acceptance is I want to trade the next bar. I want to trade the next bar. Okay, and I'm going to show you how to do that. Okay, so we have a trap. We have trap is an edge. Okay, so if the market goes like this, and then someone thinks that this market is going to sell, it's been selling for some time, and all of a sudden the market comes back to close like this, someone is trapped, someone is crying, someone is scared, someone is in despair, someone is hooked, right? This is edge. If a trader, how do you make money on a zero-sum game? If everybody thinks that this is going to be a breakout, and the market breaks out and they start to buy, and all of a sudden the market goes like this, they are in pain. We want to make money from people's pain and greed, from people's emotion. That's what we're trying to do. So trap is edge, and take nothing away from this. Edge is difficult, guys. Edge is hard. Edge is hard. If I tell you to go to a betting store and take take 3 odds, right? Take 3 odds. How can you put $10,000 on these 3 odds? It's difficult, right? It's difficult because it's difficult. If they give you as much as 3 odds, it means that the likelihood of this to play out is low. Let's say Real Madrid is playing, let's say Osasuna. What would they give Real Madrid? They can give Real Madrid, it's been a long time I looked at these numbers, but I still believe it should be like, let's say 1.5. It should be like 1.5, right? Because there's a high chance that Real Madrid can win. And then they will give Osasuna, let's say 4.7 or 4.5. Now, this is 4.7 odds. Can you put $10,000 on it? No. Because the chances of it happening is low. So, edge is hard, guys. Edge is difficult. Edge is hard. Edge is not as easy as everybody's saying. Look at it. You know, everybody's saying, oh, 1:10, 1:. It's difficult. If I give you ₦1,000,000, can you put it on it? Can you put it on it? So if I can give you something and tell you this is 1:3, and we can have around a 50% win rate, this is gold. You can literally build your career around this. 50% one is, just know that each time I play this game, I'm going to either win 3 times my money or I'm going to lose my money. It's a 50-50 thing. For 1:3, this can set you up for life. This can change your story, literally. Okay. So trap is edge. This is what I want you to know. Trap is edge. Enter where the masses put their stop loss. You're going to see that everything I'm saying here is encompassed within a twist of fate, right? Everything. Twist of fate touches around this concept. We're buying into strength. We're buying into strength. We're trying to put our entries where the masses have kept their stops. We're trying to trade trap. We want to see people who are trapped so that we can get in. And that's why we're doing all these things, because edge is hard, right? Edge is difficult, right? We're not trying to predict anything. We are not trying to predict anything. We are only reacting. after the market tells us, I have trapped someone. I have trapped someone. Now it's time for you to get in. After there's a twist of fate, right? Then you get in. You don't predict. You don't try to pick the bottom and say, oh, next bar is going to be bullish. So since I know next bar is going to be bullish, I'm going to keep, trying. And then you keep trying, keep losing your money. No, we're going to only react. No picking tops, no picking bottoms. How high? Where is it going to reverse? You don't know. Where is it going to reverse? You don't know. Where is it going to reverse? You don't know. How many attempts should you have? It's part of the rules. We must take care of all these things. My apologies if you can hear my dog barking. The puppies. He just littered and he's got puppies. So they're usually playing and barking. Apologies for that. Okay, now you must always ensure that you have asymmetric risk to reward. What do I mean by asymmetric risk to reward? Before taking the trade. So if I'm going to take a trade, I'm going to ensure that I'm not. If I enter here, right? What is happening? My target will be somewhere here for 1:3. Is it not? My target is somewhere here for 1:3. This may be possible, but it's not as good as someone who is trying to enter here so that his target will be here. Do you see the difference? So we're looking for entry. We're going to put a line here and then go on to the lower time frame to look for an entry below the open of that bar, or the close of the previous bar, I beg your pardon, right? Below the close. So if the bar closes here, we mark the close and then we go below the close to get in. All right, so take note of that. Now another thing is you must stay objective. You got to stay objective. Okay, everything must be objective. The market is random. Your approach should never be random. It must be objective. How am I entering? What is my stop loss? What is my target? Everything must be objective. Do not be greedy. Never be greedy. Don't try to say, oh, instead of taking 1:3, let me just put it where the target of my phase 1 is. Let me put it where the target of my phase 1 is. After all, this week is going to be bullish, right? Don't do that. All right. And then we're going to trade strong technical levels, right? Why are we trading strong technical levels? Because we want to see momentum. We want to see the market move, right? And then why are we focusing on openings, sessions, right? Active sessions, because we want to be sure that momentum is imminent. We want to be sure that there's volatility. Market is going to move. There's volume, right? We cannot see volume to say, oh, this bar has volume, is going to move in Forex, right? So what do? We come at the trading sessions, like the New York, like the London, when we know that volume will definitely come in, right? So that's what we're doing, because we cannot see volume. We need volume. We need to say, oh yeah, the market is going to move now. Okay, all of this is incorporated into twist of fate. All right, take note that the institutions always place their orders around round numbers. So round numbers is an important concept that you need to master. Will they say 1950 instead of I'm buying at 1936, 33, 39? Which one would they say? 1939 or 1940? 1940, not 1939. So if the market is giving you a twist of fate or a trap around a round number, you have a good confluence. The institutions will never participate unless they drive the market lower. Take note of that. This is a very important thing that you need to know. If Asia is ranging here and today is going to be bullish, the institution will never. This is the close of the previous day, right? This is the close of the previous day. Asia opens around the close, right? We have the true open at 5 a.m. Now, this is Asia. We know that the market is going to be bullish for the next day. The next bar is bullish. The next bar is bullish. Institutions will never buy up here. They will never. If they don't drag it down at London, they will drag it down at New York. So what do you want to do? You want to trade with them. You want to trade with them. So you're looking to go in. You're looking to go in somewhere there and then join the guys. So institutions always love to drag the price lower so that they can get a better price, and then they can trade from a better price. Take note of this, guys. Take note of this. Please take note of this. All right. So all of these concepts are described in the twist of fate. All right. We're using multiple time frames. We're saying, okay, let's look at daily. Let's look at H1, for example, and then let's look at M3 or M2. The more time frames that we're looking at, the higher. Daily, next bar, bullish. H4, we need 2 consecutive bars. So from the moment when H1 is telling us that there's a trap, right? There's a trap. What do? We go to M3 and look for an entry. That's all, guys. That's all I'm teaching. This is the model. Just 3 steps. Just 3 steps. Just 3 steps. Daily tells you your next bar, or weekly tells you your next bar. H4 tells you when there's been a trap, and then M3 gives you your entry. Entry is the capitulation. You want to see some people think that, boy, this market is going to sell. This market is going to sell. And then you arrive at the twist of fate. And then you go for 1:3. That's all we're saying, guys. That's all we're saying. Trade with edge. You must trade with edge. Right? Take only setups that will work more times than they will not. Don't buy everything. Don't buy everything. Always ask yourself, can I put in a substantial, think of any substantial amount. Can I put in, $500,000 on this? Can I put in $1 million on this? Can I put in $10,000 on this? If I have $10,000 now, which is, let's say, my rent, right? Can I put it on this particular trade idea or this trade opportunity? If you cannot, it is not worth it. All right, I'm going to cut this here, and then in the next video, I'm going to continue to describe twist of fate proper. Okay, and then we'll still look at some of the entries, and then we look at the trading plan, and we take some samples, and then I'll give you an exercise. Okay, so for now, what I want you to do for me is we're going to have a group. I'm going to create a group where all of us will be. You show me signs of acceptance and refusal on your chart. Okay, show me signs of acceptance and refusal on your chart. You can do that on your Twitter. Tag me to it. Show me the image. Show me this. Just mark up your chart and say, okay, this is refusal, this is acceptance, next bar is bullish. This is refusal, this is acceptance, next bar is bearish. This is acceptance, next bar is bullish. This is acceptance, next bar is bearish. This is refusal, strong refusal, next bar is bullish. Weak refusal and acceptance, now next bar is bullish. That's all I'm asking from you guys. So thank you so much for being with me here. I'm going to continue now, but I'm cutting this so that we have 2 parts that will be easier for you to consume. All right, so see you in the next part.